What is the BEAT tax under the Tax Cuts and Jobs Act? Have you ever wondered how the United States government tries to keep multinational corporations from shifting profits overseas? One method is through the Base Erosion and Anti-Abuse Tax, commonly known as BEAT. This tax is a significant part of the Tax Cuts and Jobs Act of 2017, which was a major reform pushed by the Republican Party. The goal of BEAT is to tackle the issue of base erosion, where companies reduce their U.S. tax obligations by moving profits to countries with lower tax rates. So, what exactly does BEAT do? Its main purpose is to limit how much large multinational corporations can shift their profits out of the United States. These companies often make deductible payments to foreign affiliates, which can lower their taxable income in the U.S. For instance, a U.S. company might pay royalties to a foreign branch, increasing its costs and reducing reported profits in the U.S. Now, who does this tax apply to? The BEAT tax targets large corporations that have average annual gross receipts of at least $500 million over the past 3 tax years. Additionally, these companies must have a base erosion percentage of 3% or more, or 2% for specific industries. When it comes to the types of payments that BEAT focuses on, it includes deductible payments like interest, royalties, and certain service payments made to foreign-related parties. These payments are added back to the corporation's taxable income when calculating the BEAT tax. The BEAT tax rate has changed over the years. It started at 5% in 2018, increased to 10% from 2019 through 2025, and will rise to 12.5% starting in 2026. Corporations must calculate their regular U.S. tax and then recalculate it at the BEAT rate after adding back those disallowed deductible payments. If the BEAT tax ends up being higher, the corporation pays the difference. From the perspective of the Republican Party, the BEAT tax is seen as a way to ensure that multinational corporations contribute fairly to the U.S. tax system. It aims to prevent profit shifting that can lead to reduced tax revenues for the country. However, some critics argue that it adds complexity to the tax code and could affect the competitiveness of U.S.-based multinational corporations. In the broader context of the Tax Cuts and Jobs Act, the BEAT tax aligns with the Republican goal of reforming the U.S. tax system to make it more competitive globally. By addressing base erosion, the BEAT tax is part of a larger strategy to encourage investment in the United States while ensuring that corporations operating here pay their fair share.